Good morning. It's Thursday, November 20th. I'm Phil Streible, Chief Market Strategist at Blue Line Futures. So I'm going to do this Metals Minute just a little bit different here. I'll give you the 30-second rundown on the markets, and I'll give you the idea that I'm presenting on CNBC. So looking at the markets here, we do have a bit of pressure going on in the metals markets. We've got quite a bit of a rise here in the U.S. equity markets. So you look at the S&P 500 up about 1%. You got the NASDAQ up about 1.5%. The Russell's up 0.5%, giving up some of its gains, though. You look at the precious metals markets, really quite a volatile ride here yesterday. You do have gold down about $28, so that's about 0.7%. You got silver down almost 1% here, down 43 cents, trading at 50.42. So just a bit of pressure on the metals markets here. You got Bitcoin rising. Remember, it pushed back below that 90,000 mark before starting to jump up here. You got the dollar index essentially flat in the foreign currencies. They are a bit mixed. Now, you do have some rising 10-year treasury yields here up at 4.14%. So you do have the 10-year note under just a bit of pressure. So really what happens here is you got some rotations that are taking place. Remember, a lot of people were concerned about AI, the bubble, NVIDIA, valuations. You've got quite a bit of volatility going on in the U.S. equity markets with that volatility index getting up to about 24. That's where you start to see wide ranges back and forth in U.S. equity. So I believe that some of the people, they trimmed off some of their positions. They went into the gold market. They played a little bit in the silver market here, and they were waiting for some of the dust to settle and kind of get an all clear before they rotate back. Remember, this money, it just rotates around into different asset classes, and you get a lot of people that are playing just the momentum trade, and they're taking safety in different areas. So if you look at the odds of the December interest rate cut, well, they took a dive yesterday, going down to about, as of this recording here, 31.8% chance that they cut rates at that December 10th meeting. You go to the January meeting, now it's about a 35% chance they leave rates unchanged, but they are really still leaning on that interest rate cut happening. So that's what kind of took that market here lower and had that intraday volatility in the gold market, because when I started the recording yesterday, silver was up about $1.50, gold was up $50. It looked like we were breaking out to the upside and everything else. And I'm sitting here listening to the Squawk Box. And basically what happens here is that we get one piece of news that comes out. And from that point forward, it was obvious that they were going to take the market down. So those who are hoping for that quarter-point interest rate cut by the Federal Reserve during that meeting in December, they received two really discouraging pieces of news. And it was first that the Bureau of Labor and Statistics, they announced that they're not going to publish that October payroll report. So the agency, they indicated, and I thought it was kind of goofy. I'm like, how are they not going to release this report here? It said that they couldn't retroactively collect that data in October. So if they're shut down, they're not collecting data, and a lot of it is household surveys and things like that. So you just can't go back and recreate that. So instead, the current employment statistics data, it will be included in a November report here, which is set to be released December 16th. So that is 6 days after the Fed meeting. So basically, a lot of this interest rate cut, what we've been anchoring on is, remember, the two components of it. You got to have the declining inflation, which we haven't gotten any inflation report. And one of the things that I tell people to always look at, a simple thing to look at here is, where is energy prices? Where have they been going? And you look at crude oil, they're down about 24% this year, and then the steady downtrend, and it makes up a large portion of the inflation. Just one simple thing to look at there. You look at food inflation, it's also been coming down. Look at your live cattle charts, feeder cattle, things like that. So you see inflation is coming down, but we haven't had any data there. And then the other aspect that really kind of got the party started on the interest rate cut was the weakening labor market, but now we're not getting that data to reaffirm it. We saw the ADP at 42,000. We also saw the ADP, the weekly change here, showing these losses of like 12,000 jobs per week here. And so it should have come out, and it should be driving that forecast for that December interest rate cut, and we're just not getting it. So gold is taking a bit of a breather on that, and then you got that kind of rotation that's been going on here into different asset classes. A lot of people are going to chase the NASDAQ, mega cap tech. They're going to try and pick the bottom on Bitcoin, and they're going to just exit some of these things, but they will come back to it here. So it's just the absence of the October jobs report weakened that case for the December interest rate cut. Now, the second thing that I was going to talk about is that I'll be on CNBC here later on today on Power Lunch. And basically what I'm going to do is I'm going to discuss the possibility of gold reaching $5,000 an ounce in 2026. So Where we sit at last year on the December contract is $4,050, down about 27 bucks. We did see a dip below 4,000 briefly about 2 nights ago, where the dip buyers came in, drove it up here, and then we saw that upward momentum with the rug pull yesterday. So what I'm going to do is I'm going to look at the February contract because there's just not a lot of time on the December contract. I'm going to present an idea there. So basically, the overview that I'm going to give them is that as we enter the back half of the fourth quarter of 2025, we begin 2026, that the momentum for gold has been truly remarkable. So prices surged 10% in September. That was the best monthly performance since 2016. You had that 5% push up in October where we hit the all-time highs. You got 4% rise here in November, and then you're up about 52% year to date. So the positions in gold, this positions gold for its biggest annual gain since 1979. And I'm saying that with the right conditions, we could hit $5,000 an ounce in 2026. So I'm going to say that the outlook remains incredibly optimistic, that globally, so this is another aspect here. If you're working closely with me, that we had positioned bearishly in the euro currency. We're anticipating that with the Fed unable to cut rates in December, that the dollar index would strengthen. So the best way to play that from an inverse aspect here would be bearish on the pound, the euro currency, the yen, things like that. And if you pull up the charts on all those, you can see that they're breaking down. So many of the clients working closely with me, what do they have? They have put options or short futures in those particular things. So those are starting to benefit. So you see globally, we see many countries face declining growth and rising inflation. That's specifically like Europe, the UK, things like that. UK just printed one of their largest unemployment rates here since COVID, and then also their inflation is continuing to tick up. So what's it do? It creates a stagflationary environment that benefits gold. So gold trades near its all-time highs against the Australian dollar, the British pound, the euro, the Indian rupee, the Japanese yen, in conjunction also with the dollar index. We're not that far off. And then what I'm going to say here is that there are 3 really structural drivers that are going to continue to support and strengthen gold into 2026. And the key is that you got to get things all happening at once. You got to get the party all together. The band has to come back together. And that's what we saw with silver back in October, where all of a sudden you get this physical squeeze going on. You got investment demand. You've got strain in the supply. You got the unable to just get it out of the ground fast enough. And then you get the AI demand all happening at the same time. And that's how silver powers through and goes on up to 54. When it broke, and it fell back down like $9 corrected from its high, what happened? One of those pillars that was driving it upwards, that tightness over in London, that came out of the market. So in the gold market, you really have all these things working at once. So you got the central banks, they're continuing to diversify away from the US dollar, other currencies, they're increasing their gold reserves. That adds to structural support to prices because they are less impacted by where price fluctuations are. They just have these quotas where every month they're continuing to add to it. And this really began in 2022 when Russia had invaded Ukraine, and then all of a sudden they were taken off of like SWIFT payment systems and their assets were being seized. So what they did was they got rid of a lot of their foreign currencies, and what they did was they boosted their gold holdings. So the average central bank holdings are right around like 20%. You go to China, they sit at about 8%. And we believe that the goal is for many of these central banks here, whether it's like Poland or different emerging markets, things like that, because they need to have better FX reserves. They want to bring this up to 30%. So that's where you get this multi-year trend that is aimed at hedging against geopolitical and financial risk. So then that's one aspect. Then the second aspect is the ETF flows and the portfolio diversification. So where we work in Blue Line Capital, where we outshine many of the different money managers out there, the investment advisors, is that because of the fact that Bill, myself, our team have this commodities background, that we're able to add slices and buckets into the wealth side of things where we add these real assets and they tend to perform well in rising inflation and give portfolio diversification. So the investor enthusiasm is reflected. in the 17% increase in gold ETF holdings this year. That's why I monitor that when I do the regular metals minute, is one of the things we touch base on, which way is the flows going, because what we don't want to see is that their appetite changes and all of a sudden gold ETF flows go unchanged, silver ETF flows go unchanged, and no one's interested in that, because that would be a big blow to the pillars that are holding this market up. So what's happening is more individuals and institutions, they're recognizing gold as and cementing it as a position of strength within their portfolios. So you get the investor portfolio diversification. So what investors are starting to realize is that having a 60-40 portfolio, it just doesn't work anymore. You can't just have all bonds or 40% bonds, and then you get all these stocks and you get maybe a little bit of international and things like that. You're just not going to outperform it well. And in certain environments, you're really going to lag. Like in 2022, I talked to a lot of people. They were down 18 to 24% with that traditional portfolio. So what you want to do is you want to add small slices of things. So they're starting to add strategic commodities, whether it's like nuclear, gold, silver, copper, oil, Bitcoin, things like that for portfolio diversification. And it only takes small amounts of it that will help hedge against inflation, currency debasement, geopolitical risks. So then the third aspect, and this is where gold has pulled back here just recently, is the Fed easing. So although the timing with December is uncertain, it's the direction of interest rates which remains clear. And what's the direction is that we are going to head lower. Now, we aren't going to go to those COVID lows or things like that, but what we'll do is we'll come down and then we'll start to level off, and the Fed needs to be in a position of strength where if inflation doesn't tick up, they start to raise it again. If we go into some kind of recession or something like that, they can continue to cut it. So it's not going to go back down. So you start to see that they're going to restart those rate cuts in 2026. And that's what lays the groundwork here for the next leg higher. And the way we get that groundwork and we get those interest rate cuts is that we need to start getting consistent data releases that would help lift the fog that the Federal Reserve is seeing here and give them a path on interest rates and give investors greater clarity on key official economic data. We can't have it where we're expecting this economic data release to come out and it's going to reaffirm what the nowcast models show, and then all of a sudden it's kicked past the next Fed meeting. That's what happened yesterday, and that's where the sell-off had occurred. So you need to get clarity on these key official economic data releases such as jobs, inflation, and shift the market back to focusing on the U.S. fiscal outlook. Now you can see that the fiscal outlook is deteriorating over in Europe and the UK. That's why being short the euro currency, and that's what we were doing with the put options, and being long gold at the same time. Well, if you know guys like Dennis Gartman, they would say, oh, gold, we like to own gold in euro terms or pound terms. And what they're doing is they're essentially short one currency and long the other. So that's when you want to look at things like that, is when there's a strong inverse correlation between the dollar and the euro currency, and the gold market. And what we're seeing right now is that correlation isn't that great at the moment. And that's how you got gold going up and you got the dollar going up at the same time. And basically that currency debasement type of trade is rising the gold market here. So the next setup that I'm going to talk about here is kind of this seasonal strength. And this is where I got to tell you guys that past performance, it's not indicative of future results, right? So it's something that we do look at. Look at September. They say it's like the worst month for the stock market. What happened is that the stock market just ripped higher during that. But so what I'm going to talk about is I'm going to say that, hey, if you buy the February gold contract around Thanksgiving, and then you sell it out in late January here, that it's worked out 13 out of the last 15 years with that disclaimer, past performance not indicative of future results. And then I'm going to lay out this trade idea where I'm going to say, okay, where's the recent support levels on the gold market? And it's 3,900. We don't really want to see it go down below 3,900, 3,850, something like that. So I'm going to recommend them to buy the February gold contract, whether it's $4,100, $4,050, something like that, something somewhat actionable close to where we're at. Have the stop loss below that 3,900 mark, and then target that $5,000 move. Now, I don't believe we're going to hit $5,000 obviously in the first quarter, and something like cataclysmic happen. But what I would say is this is a position that gets rolled over from, Feb to June to December, and we try and catch this long wave up. Now, 5,000 isn't like a year-end price target. It's just saying that we plan for a scenario where we could see $5,000 in the cards, and that would be where the Fed kind of hits its terminal rate, central bank buying happen, and things like that. And that's what marks an intermediate term top for the moment in that particular gold market. So those are the things that I'm going to lay out. And then gold, really, it just tends to struggle because they'll push back on me. They'll be like, well, gold futures are under pressure right now. And I'm going to say that really the bear market begins in the gold market is when you see the dollar strengthening along with rising interest rates, but it's a breakout on interest rates. And what happens is the Fed has to adopt to a hawkish stance in response to growing economic activity, which is fueling inflation. And in those such scenarios, the Fed is likely to raise interest rates, and the Fed is not likely to raise interest rates right now. So we don't have that kind of situation at the moment. So a much longer metals minute, but I want to give you kind of like what my broad-based thought basis on kind of what happened in the last 24 hours with the metals markets, and then lay out this idea that I'm going to give to them on CNBC. Now, many people inquired about a silver spread. We put those on. It was it's a call spread that goes out to March here, and we're kind of looking for gold to catch waves, silver to break out to the upside. Silver has these higher lows on the charts, so there's nothing for me to be too alarmed about the silver market here at the moment. You might get some risk off because of the fact that they're rotating into different assets. Remember, this money is trapped somewhere. Like if you were to log into your account, you can only trade certain commodities. You log into your stock account, you can only trade certain things or park in cash or whatever. The money's going to go somewhere, and it's going to be in that account, and it's going to have to flow into different asset classes. So again, you guys got any questions? That particular trade idea, remember there's 1 ounce, 10 ounce, 50 ounce, 100 ounce contracts. So people really need to think about what their current situation is as far as risk capital and things like that. So it's not a formal trade recommendation out to the public. It's just what I'm going to lay out as an idea on CNBC. So you guys got any questions, send an email. You want to open up an account with us? We have tons of people open up accounts. They love working with us over here. Send an email to info@bluelinefutures.com. Remember, futures and option trading does involve risk of loss. May not be suitable to all investors. Good luck, good trading.